welcome back, traders and investors. This is Joel Alconin along with Andrew Giovinazzi. I hope I got that right. He is COO of Option Pit. He has served as member both of the Pacific Exchange and the CBOE, where he actively traded main markets in equity and index options. Andrew, how you doing this morning?
I'm doing good. Thank you for the kind introduction there.
Okay, so tell us about a little bit about your background and your experience, and then what you're doing now with Option Pit.
Okay, sure. I was an option market maker for about 15 years, from 1991 until 2006. Then I kind of retired from the business once electronic trading came in. It wasn't quite as much fun for me anymore, and I kicked around trying to start a couple companies. And then actually Mark's had Option Pit going, which was I think back in 2011. And I noticed his curriculum was really similar to what I used to teach at Group 1 when I also taught traders how to trade while I was a floor member. And the program I thought was really good that Mark came up with, and he needed some help, and here we are, almost 3 years later, and I'm basically chief operating officer now, as Mark is moved to helping basically manage a fund, and I'm taking over the role of the day-to-day teaching and trade selection and things like that. That Option Pit.
What post were you at on the Picos? Because I actually spent a couple of weeks out there when I was a trader for Oldie Discount, and they sent me down to their operation on the floor for a couple weeks, and I think I was at the Home Depot post.
Oh, the Home Depot post? I was in the Susquehanna DPM for a while. I was in another DPM that traded all like sort of the Chinese internet stocks.
Wow.
Early on, I mean, in like 1990, I was in the shearing plow post.
So you quite a few, huh? Wherever the action was.
I traded. Well, you try to be where you think the action's going to be.
Okay. So
you never know where.
Let's talk about options trading here. It's something that's really taken off over, the last several years. There's pros and the cons to investing in options. Could you go over some of the pros, versus stocks, and then some of the cons?
Sure. I think one thing, the pros of options is you have to make sure that you first you have to know what you're doing with options. They provide a tremendous amount of leverage for the dollars. A lot of times I prefer to buy options instead of stocks just for the dollars involved. And in general, what I'll do is just move my time horizon out a little farther. I think one of the bigger cons for options is people or traders use them in a way to kind of increase the risk and speculative nature. And it really doesn't leave them with an out. And the best thing about options in general is you can control risk. If you understand how to put a position together, you can control risk to a fine degree. You can control how much decay do you want per day. You can control how many deltas you want, or basically your long exposure, short exposure, for the amount of dollars you want to spend. You can dial in exactly where you want to own a stock, where you want to sell a stock. So you have what ultimately is, unlimited control of what you want to do. But on the con side, if you don't understand how that control factor works, you're going to get yourself. You could potentially get yourself into some trouble.
Right. Well, that's on, that's especially if you're on, right in the options end. There's a lot of things that they can go wrong. There are people that have been selling puts and out of the money puts forever, and you probably know from your market maker days when those days of reckonings come, and those penny and nickel puts that they were selling all of a sudden go to astronomical numbers. Bad things can happen, but I think the retail trader probably takes a more conservative approach. To me, the big con, on the options as opposed to holding the outright equity. And I'll just go back to my, some of my trading losses in Apple last year. Trying to anticipate moves with technical analysis, and trying to peg the timing of the move and buying, weekly options, and then getting a little more brave and going out a month or two. I think, to me, the timing of the options is, to me, is the thing that's most difficult. How can traders learn? How can you get around that?
Well, you get around the typing by creating trades that give you a range of motion instead of just like one direction. So you could think of it like this: if you just buy an option, you need the stock to go up. You have no choice, right? If you buy a call, and if you trade things like iron condors or iron butterflies, just for an example, or we do a lot of modified short option plays, um, where you're basically selling spreads, but what you're giving yourself is a range. Instead of Apple having to go from 550 to 600, Apple just has to stay somewhere between 600 and 525 for the next, 10 to 15 days. And what that does is it kind of alleviates some of the pressure on the position having to expand right from the get-go. And, I think technical analysis and all that's fine for some people. It's not something we really use at Option Pit very much. It's good to know where those levels are because that's what a lot of other people are thinking about. But you could also structure trades around those technical analysis points too. You could create ratio spreads that are built to explode in a good way around one of those technical analysis points if you want to. You could also create the spread. If nothing really happens, the spread collapses and you don't really make or lose money. So you just have to, again, like I said, you have to decide what type of position you want to put on. But I'll agree with you, timing is very difficult. And, what I tell my students is the shorter duration, the less chance you have to be wrong. The longer duration you have to let things work out a little bit, it gives you a little bit more chance and flexibility and even to adjust the position slightly if you need to.
Okay, so if you're not basing a lot, I mean, I know you're incorporating some technical analysis into your work. Are you paying attention to the fundamentals? I mean, ratings changes or earnings or mergers and acquisitions. Is that something that you base some of your strategies on?
Right. A lot of our strategies are volatility based. We mostly do volatility ARB. We do fundamental analysis as far as like what type of position a stock can handle. So I would say a position for a stock like Apple that's $500 that has the potential to move $20 or something, $10 a day is a different position. Let's say I would put on in like in a Microsoft or an Intel because the characters of the stocks fundamentally are different. So by using vol arb, which is what we teach mostly, we're trying to get traders to learn how to spread and take advantage of volatility spreads and create positions based on fluctuation of volatility. So in that sense, that's kind of the technical analysis we use is just teaching people how to read volatility conditions in the market and then put a trade on in that way. As far as fundamentals go, you have to look for a stock or underlying. It's a good vehicle for the option position you want. So, if you're trading a highly speculative stock only really can handle certain types of option positions. You can't sell naked contracts unless you're bringing yourself really unreasonable risk. So what we try to do is focus on where there might be an opportunity given whatever's happening with volatility on a given day, and that's sort of what we go through on a day-by-day basis option pit.
So you have more of a watch list. I mean, some of my trading, I like to watch a specific group of stocks, and then if I see a technical setup, then that I will migrate towards toward that stock. But is your strategy? Correct me if I'm wrong. Are you using the whole universe of stocks? You're analyzing the volatility, and then if one gets to a certain part, high volatility or low volatility, then you will look to create a position in that issue.
I think that's a pretty good description in a nutshell. I think we look mostly at around 250 equities because, too, our clients, you need some volume to be able to get in and out. We look at most of the major indexes, and we look at all of the volatility products. And that basically is our universe. And normally we can find something of interest on any given day. But that's essentially what we do. You try to get a sphere that you understand relatively well. And when the market moves to an interesting spot, that's when you will put on a position.
Any luck with the weekly options?
We use weeklies a lot to sell, mostly time spreads, which tend to work pretty well actually, because you can control the risk like double calendars. You can be a little bit more aggressive with the weeklies, especially when the underlying's moving a little bit and they get pumped up. It makes interesting double calendar plays. You can generate some theta. Do we punt a lot on the weeklies? Mostly what we'll do is we will use them in the vol products, especially when volatility looks like it's set to move, because in general, the gamma is very cheap in there, just meaning that, you can buy relatively inexpensive weekly options on the back of, let's say, a Fed move, or once the volatility's had a big move up, maybe looking for a retracement, you can get a lot of leverage in those options. So that's just one of the strategies we teach when the product gets to a point where the trade actually becomes interesting. So we'll use weeklies in that way, either trying to buy that cheap leverage or sell them mostly in time spreads. Every once in a while, butterflies or some sort of butterfly construction like that to kind of pump the theta up in the option a little bit.
Okay, so you just get to a little bit of market talk here as far as like your strategy when you think the market is at an inflection point or at a top. I mean, just talk about that in general and maybe a specific strategy.
Sure. Okay. There's two. Well, one, when we think the market's kind of toppy, we like iron condors or something similar to that. And it's not so much as we think that the market's going to crash, but it just sort of falls off the top. A strategy like an iron condor isn't bad because by nature it's a little short delta, so it gets you a little short at the top, but it also gives you a lot of room for the market to kind of swish around in the middle. I don't like that type of strategy, let's say, when the market's rallying hard. I think it doesn't work very well because you're constantly fighting the short delta the whole way. Another strategy we use is we do have short positions in the vol products. Now, when the market is trading kind of more on the upper end, what we'll do is we'll look at protected straddles, where we'll buy a straddle and then hedge the volatility away in the volatility products. That way, if the market falls apart, our straddle blows up and our volatility protection goes away. So those are basically what I'll call like a long-short pair, where you sell volatility, let's say, with an iron condor, but then you buy some leverage with the straddle somewhere else. So that's, like right now, those are the type of things that we have on, actually, where even if the market falls apart, we own contracts, so the position itself will explode in value, which is good. The market does nothing, we'll pick up a little theta. And you really only can do that when you have volatility at this level. We're trading like 12.5 fix or something like that. So picking up contracts is very cheap. Normally, it's kind of hard to buy a contract and make any money because of the decay, but right now it's sort of setting up okay for that.
And so the market, I mean, we came awful close to, I'm talking about the futures here, 1900 in the S&Ps, and we've fallen back a little bit. We've had an extended period of low volatility here, interest rates low, forcing people to go back into the markets or stay in the markets. What's your short-term and long-term forecast for the VIX?
Oh, for the VIX?
Yep.
Short-term forecast, we're staying kind of this 12 to 14 range. I think breaking below 12 is going to be very difficult. It seems like every time we get to 12, it bounces. So short-term, maybe 12 to 14. It might long-term break that bound if we get a surprise. bad earnings, because right now there's a little bit of earnings worry. But I think long term, I think the VIX stays in a tight range, and I still think we can see lower levels in the VIX this summer if the status quo just kind of keeps playing. Bonds stay steady. The economic news is okay but not great. Those are all recipes for really grinding the volatility down for the most part.
And if we're going to have an extended period of low volatility here, that just kind of portrays that the market's just going to climb this wall of worry and continue to move higher. I think that it's Jeremy Siegel and Barron's over the weekend looking for 18,000 in the Dow. Are you kind of in that camp?
I Let's just say I own a lot of stocks, but I own some protection. So I
There
think
you
one
go.
of the good trades is you're just long and you own some positions that protect you in case things blow up. What we haven't seen a lot of demand for that downside. So I do have a long bias for sure right now. It's not as long as it used to be.
Okay.
um, but yeah, I do have that, but I'm also spending a little bit more money on buying some puts and some protection just in general.
Well, I was going to ask you for some final advice, but you just gave investors and traders some excellent advice in the markets. Participating, but also having some downside protections. Andrew, thanks a lot for coming on the show today. Andrew Giovinazzi, COO of Option Pit, sharing some of his strategies and his outlooks on the market. Andrew, thanks for coming on. Have a good day. We'd certainly like to have you back.
Hey, no problem. Thank you for having me. Bye-bye.
Okay, thank you.